It wasn't the free fall that we had last week, but there was a little bit of a roller coaster ride this week. It wasn't nearly as big of a range. The range should probably start to get smaller again next week. But I'm going to break down how we ended the week, what was really driving, put this move and this volatility in context of a bigger picture and what that means, as well as, again, another way, kind of continuing a theme, another way to trade this abnormal and rare extreme moves that we don't get very often, but when we do, we can really take advantage. And I'll show you another way to do that today. So let's go ahead and get started. Today is Friday, October the 19th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those of you watching us for the first time. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel by mousing over this logo right there, right in the bottom right corner of your screen, that Market Scholars logo. When you mouse over that, a red subscribe button pops out. Click that button. That will give you notifications when we post these videos, when they come up every day. Also, click the thumbs up icon that's down below the video. That tells me two things. Number one, you got something out of it. You liked the video today. Number two, it tells me with one click that you want us to do it again on Monday. Really simple, easy way to give us feedback. Let us know what you think about the video. You can do that right now while you're watching. Also, comment on anything that stands out to you. We'd love to hear what you're getting out of our videos. You can scroll down to the very bottom of the page to do that. Join our daily Market Outlook email list. There's a link popping out in the top right corner of the screen. Click that link to subscribe. The timestamp summary of everything we talk about in these videos in that email, as well as a daily watch list of stocks that are showing overbought or oversold clusters from the market forecast indicator within the S&P 500. Follow me on Twitter for more content like this throughout the day. Join our Market Outlook community that we created on Facebook. All right, as we always do, let's start off taking a look at the S&P 500 with the market forecast indicator. Short-term sentiment pulled back. We now have the near-term line below 50. So we had 20, yesterday was at 55, today at 21. So 3 days above and now 1 day below. Still hasn't crossed below 20 yet. We finished today at 21.21. We were looking for that blue line to pull back. Now the issue is, how far will it pull back? Will it pull down into this reversal zone? If it's going to be bullish, then it needs to stay, maybe dip its toe under the water a little bit, but pretty much stay above 20 and bounce back up within the next day or two. So Monday or Tuesday, we should expect it to bounce back up and then get back above 80 if we're going to maintain bullishness. You can see the intermediate line's rising, but if you look at the visual, it's barely rising. Yesterday was at 30.66, today at 30.72. A little bit of pullback. You notice similar pattern to what we got right here, where we had the big drop, we had the decline, then we had an evening star candlestick formation at the bottom of a move instead of at the top. Here's what it looks like at the top of a move over here. So this would be more at the bottom. Here's another one at the top of a move. Where you get the evening star candlestick formation. So here it is again at the bottom, followed by a day with a long upper shadow, and then eventually we worked our way out. So that was the first. This evening star candlestick pattern was the first near-term peak that produced the weak bullish posture. Then the next one is what got us up to a new high, this one right here. So, and helped eventually get the intermediate line above 50. So that's kind of what we got right now. We got the first near-term run that brought the intermediate line back out of the reversal zone, formed an evening star candlestick pattern. Today we got the long upper shadow, so we'll see if we eventually roll out of this Monday and after expiration into back up above 2,800 into a new near-term high point like we did before. See this run over here lasted 8 days, so it lasted a lot longer. Then that's more normal from what we expect to see. So weak bullish posture still, about as weak again as you can get. It's still pretty close to 20 and it's pretty flat. So it's not the most bullish posture, but still it's not falling anymore either. And again, you can see if the near-term line does bottom out here in the next day or two and does rally, it would be a higher near-term low point. So that would be a bullish low, higher low corresponding to a bottom on the blue line that does not get below 20, and then it rallies, and again getting back above 80 with a high above this level, 28.12, would be a new bullish near-term high. So that's the kind of pattern you expect to see, and that's what we'll watch for to see if we get it or not. If we don't get it, then there's a good chance, again, we could break down through this, out of this consolidation to the downside and continue busting through 26,700 and then down to 2600, where you'll have some major support levels in that area. So again, I don't expect that. Again, the seasonality and everything we've talked about with midterm elections and all of that would suggest that we would break out of any consolidation to the upside. But of course, anything can happen, and we would watch for that breakdown, that new near-term low, or the lack of a new near-term high to develop. You look at the Dow Jones Industrial Average, looks very similar. Near-term line not down as much. The Nasdaq Composite did fall down more, still has a higher low, and still would be higher here. Remember, these are higher beta indexes, the Nasdaq and the Russell. So they'll tend to get more volatility in their short-term lines. There's your Russell. Oops. There's the Nasdaq. There's your Russell 2000, which again today forming another oversold cluster. So we're looking at 5 clusters in the past couple of weeks on the Russell 2000. It shows again, and also sitting at the 78% Fibonacci retracement of this this long-term run that we started with these two intermediate rallies on all the major indexes. So it's at some support here. It's formed another cluster. If you take a look at the weekly chart for these indexes, you can see long upper shadow this week on the Russell 2000. Very oversold sentiment. The last time we had sentiment this oversold on a short-term basis was right there at the election, and that's what came out with both of them combined down there. That's what came out of it. Over here is that April of 2014, where we pulled down, really oversold, messed around for a few weeks before riding higher, and again 2014 kind of shows a little bit of a different. The intermediate line too was a little bit higher than where we're at right now, and if I look over here, the intermediate line was also about where we're at right now. So we can see some comparisons in the past, in the more recent past, to what happens when we are this oversold. See, we didn't look at this one. This is the one that was a little bit higher. This is the last one here in August of 2017. Again, you got the short-term sentiment about where we're at right now. The intermediate line on that day was at 57. Today we're at 55, and that was the low point. Much bigger decline now, but that kind of shows like that decline is, from a market forecast perspective, is very similar to this one right here. And so again, why so little here and why so big here? Because you had more of a sideways move going into this one, and you had a much bigger rally coming into this one, right? If you look at the return here from this low all the way up into here, you can see that's a 28% return, and over pretty much over the course of a year, 378 days. If you look at this move, by the time we got up to here, we're looking at about a 24% return that occurred. Most of the return occurring, that 24%, 15 occurred in 3 weeks, and then we dropped. See, most of this return did not occur in the first 3 weeks, and it was more gradual. So a bigger move over a longer period of time has a bigger pullback as a result, even though it looks very similar as it did over here. You look at some of these others. There's the S&P 500 on a weekly chart. Again, oversold sentiment, not extremely oversold, but bearish sentiment, weak bearish posture, pink shading occurring. The Dow Jones Industrial Average on its weekly chart, some light pink shading occurring there. Again, very small range this week compared to last week. And then the Nasdaq Composite, which has all these FANG names, again a much smaller range, long upper shadow, short-term sentiment down, but not extremely oversold. Opportunities for bounces on these weekly charts. Alright, before we look at our other charts, reminder that you can watch our video here on our Market Scholars page. You've got, once you click on that, you've got all the controls. You can change the speed. You can watch it in double speed, to speed it up a little bit. You can also change the resolution here and to get it to a high definition. If you don't see a good resolution, you also get closed captioning as well and see it full screen. And remember, you can participate in the Market Outlook forums here by clicking on that link. You have to subscribe to our site to do that, but you can do that for free by going through this image up here in the top right corner. There's our calendar, our 2 classes for next Monday, and then down here at the bottom, if you want us to keep doing these videos, 3 clicks is what we're looking for. One is to click that heart on today's Market Outlook tweet, and then click on that like button on the new window that pops up. Click on the image here, this Facebook thumbs up image. That will take you to your Facebook page where you can like today's Facebook post, Market Outlook Facebook post, and of course clicking here on our blog by clicking that like button. So either or all 3 of those clicks we look at, and we compare it to how many views we get on the video to see whether or not there's interest for us and whether you got something out of it and that you want us to keep doing it. Alright, when you take a look at this week in terms of the long-term perspective, the weekly chart, you can see last week's candle, we had a range of 184 points coming after a bearish week before that with a range of 70 points. Today we have even this week, we have a smaller range than we had on that week. So, again, that happens. You get big moves and then they're followed by small ranges, and that's the market figures things out, and it takes some ups and downs. There's some ups and downs in here. If you look at the Hakinyashi version of these candles, you can see, you had a couple bearish candles. You got lower lows on an intra-week basis, but then you got these small bodies with upper and lower shadows, and then eventually you took off. And so, we're not looking for a move to 2,900 tomorrow or Monday or next week even. But the market, according to past precedent, will figure some things out in this area right around where this 200-day moving average is, and we'll grind higher. I mean, this MACD will grind its way to 0 like it's done in the past. It usually doesn't fall off a cliff down to 0 from such high levels, relatively speaking. You can see the Dow looks even better, even smaller range. You can see a 581 point range this week compared to that week before, 650, 1,600 point range that week. The NASDAQ is holding the 200-day moving average for us, resistance so far, and then the Russell. So the Russell broke down this week. We made a run up to the 200-day moving average. We got a long upper shadow. Long upper shadows can be bullish. They're not as bullish as long lower shadows, but when you've had a move like this, now the question is going to be, are we going to be able to break back up above that moving average here next week? 1,600 roughly would be what you'd be looking for a break back up above that here next week and nullify the breakdown. Otherwise, we stay and hold below the 200-day moving average. Then we're likely to get that death cross, which is that dark pink shading, which we just haven't had since early 2016, beginning of 2015. I mean, we had from that early 2016 low point, we've had a run roughly up to this high of about 80%. That's a 31% annualized return over pretty much almost 3 years. 31% annualized return. So when you get a drop like this, it's not surprising that it's going to be as big as it is. In fact, the run off of the last time we touched the 200-day moving average off of that low point here, when we hit that low and we rallied, whoops, right there. Oops. So let me do this as right there. Up to the high, that was over what 206 days, 30 bars, so 150 trading days. This is a weekly candle. We had a 37% gain off of those lows. 37% gain. And a reminder what kind of environment that we're in this year. If I switch this returns over here on the left to a year-to-date return. So up about 3% year-to-date on the S&P 500. If you look at the Russell 2000, we're down about 0.5% year-to-date with this pullback that we've had. But then look at some of these others. So there's IWM. Russia's down, and Mexico aren't down very much year-to-date. And Brazil holding strong too. But then you have, how many, 1, 2, 3, 4 of these emerging markets in bear market territory: India, Indonesia, Argentina, and Turkey. Look at all these others that are 10% or less. You have, let's see, that would be Netherlands, Australia, United Kingdom, Sweden, Spain, China, Germany, Italy, Poland, South Korea, all down 10% or more year to date. So that's the environment that the Russell 2000 gained 30, from low to high, 21%, a 38% annualized return. So a 21% move. So when you get, moves like that, that's a strong move in an environment where nothing but U.S. stocks was going up. So you're going to get volatility. When you get volatility to the upside, you're going to get volatility to the downside, and that's why the Russell is down as much as it is down. But again, the question is going to be, are we going to break back up above that 200-day moving average? Because if we hold, then we get that death cross, and then we start to say, okay, how much further are we going to pull back here and give back some of these long-term gains that it's had? From a 3 green arrow perspective, of course, we still have the 1 green arrow on the stochastics down at the bottom. When you look at the 2-line versions, it's still above its moving average. The MACD is still coming up to its moving average. Remember, you can kind of see a move here in late March. Again, very comparison of what we're looking at here. There's that evening star candlestick pattern, the long shot. You see how that evening star candlestick pattern, then the next day with the long upper shadow, kind of gave that hiccup before we resumed. Here's the hiccup coming off of the lows, evening star candlestick pattern, long upper shadow. So are we going to get exactly the same thing? We were at least around the 17-day moving average that time. This time it only got us to the 8-day, but we are extremely low compared to these moving averages. Wouldn't be surprising that you get a bullish divergence, which would cause a slightly lower low, probably towards 2,700. But also wouldn't be surprising if we do what we did here with that convergence, makes a run back to zero really quickly after some ups and downs, at least this week. So here's what's today's range look like within the context of the intraday move. So another inside day where today's high was lower, the low was higher than what we had yesterday. So again, we didn't get a lower high and a lower low again. We didn't close below 275 today, so we didn't maintain the selling. We got that inside day and it kind of halted, and that selling halted there. So small range. You can see obviously the high here, this midpoint is going to drop back down. Well, actually, no, that's about where we're at now. There's going to be some resistance in this 282 area. This line, this purple line, is going to come back down into this area when next week's Hakinyashi candle shows its opening price. So there's going to be some resistance in that 282.5 to 281 to 282.5 area. Where it's not gonna be easy to get through. Once it does get through it, and you get the new near-term high to the upside, this would be a higher near-term low, a new higher near-term high. Then you're going to say, okay, we'll get the long upper shadow because you're probably getting above the purple line, and you'll be in the upper half of the 4-week range. You'll have a much better outlook there than what we're seeing, at least currently. You take a look at the volume and the range today. The range at see, what was the range today? 3.83 points, and the volume at 138 million, very similar to what we saw yesterday. If you take a look at put that in some context here, 3.83 is about where we're at, a little bit above it. 134 million, 138 million, excuse me, right about there. So both numbers that aren't extreme, but they're continuing to raise these higher. Today's 3.83 is above 1%. 1% would be 2.76. So we're still in that bearish territory there, And then when you look at the volatility index, we finished right around 20. So we talked about this today in our technical analysis trading room. Where's this chart here? That we get the surge. We've seen when you get these surges. In here, let's go 5-year, and then we'll go 5-year and daily. You get these surges, these extreme surges of volatility, and then you come down, and you'll bounce back up to this 1.05 level, and then you come down. You can see same thing here. You get a surge, and you come down, and you don't get another surge again. Here's a surge in volatility really quick up above 1.15, and then we drop. And then the next time we bounce, and this was really quick, but we only got up to above 1.05. So it's rare to get multiple surges. And here's the last one. Big surge, come down above 1.05 really quickly. Big surge, come down, and we're bouncing up a little bit. And we're above 1 still. We hit that 95 for resistance. That 90 to 95 level will hold for resistance. You can see how it will hold for support, excuse me, until you break down. Once you break down below it, then you'll get short-term pops in volatility up to about that 1 level, but it will stay down for the most part. So until we break down, and mostly you can see 15 is a support level when you're in that neutral zone. Until you break down back below that neutral zone, you're going to get some bigger swings than what you're normally used to on a normal bullish trend. Normal bullish trends, you're looking for lots of up days and really small up days, and it's grinding and it's slow. That's not what we're going to get right now because of how high volatility is. So you're going to get big moves to the upside as we saw this week, but that's also going to be sprinkled in with some bigger drops to the downside as volatility figures things out at these higher levels before it breaks down. Alright, so to summarize, we had a really volatile week last week. This week, a much less volatile week, even though we had some ups and downs that ultimately, by the end of the week, we really ended up getting anywhere in terms of where we closed. And a lot of the major indexes sitting on the 200-day moving average. So we're also sitting at the bottom end of last week's range with a long upper shadow. So are we going to bounce next week? Are we going to get back above the 200-day for the Russell? Are we going to get a new near-term low, bullish low, and potentially new near-term high by the end of next week? That's the things that we're watching for. Do you agree or disagree with that? Click that link that's popping out in the top right corner of your screen there, and click either agree or disagree. If you disagree, scroll down to the bottom in the comment section. Let me know what you're seeing. That would suggest either that we are going to be a lot more bearish than what we're showing here. That at least going forward from here, right? It's easy to say that we're bearish based on how we've gotten to this point, but considering where we are now and where we expect to be maybe in the next week or two, that we have a lot more room to go to the downside. Let me know if you see something that would suggest that, or that would suggest maybe that we're even a lot more bullish than this, that we'll bounce up a lot quicker than how we bounced off of these extreme lows in the past. All right, as you take a look at this chart, it's a classic risk-off chart. Stocks down 4.5% or more, a little bit more over the last 2 weeks. Gold and commodities up here at the top, agricultural commodities specifically. The dollar, foreign bonds, preferred stocks, all these. There's long-term bonds, there's high yield. I mean, these are all these fixed income type, yielding type asset classes, all right around break even for the week, or for the last 2 weeks, excuse me. And then of course here's your equities, and you can see, again, there's where we closed last week, right where my cursor is. So you can have through the ups and the downs, we ended up with a small gain. There is where we closed an emerging market, so they were down for the week. Here's where we closed with the developed markets. They were, crude oil. They were down for the week. Here is IWM's close, down a smidgen for the week. And then of course here is the close for developed markets, which are also relatively flat. So most of the volatility on the 2-week period was last week, and this week, through ups and downs, we're still pretty sideways for the week itself. Again, over here you can see crude oil It's way down over the last couple of weeks, but it's also up over 20% since year to date. So it's had a good run. Growth stocks are doing well. Commodities are doing well. The dollar's up year to date. There's a return on the S&P 500 and the small cap index. On the other end of the spectrum, international stocks and long-term bonds are your biggest losers. They're struggling now. They've been struggling for most of the year, and most everything is down. Investment grade bonds, real estate stocks, gold is down 6% with the strength in the dollar this year. Other types of preferred stocks down. High yield outpacing investment grade. Value is there, underperforming growth for the year. So, and then there's your dividend stocks holding up some decent value. So you can see for the most part the year's been relatively positive again, especially when you compare it to all the other major economies that are out there that are either in correction or bear market mode. And again, if I were to change that to the high that we had in January, most of these are down 20% or more since the January peak. So it's really this environment that we're in, a global equity environment, has been a bear market. And so, a lot of people are saying, well, why are we so bearish and why are we not up 20% this year? Right? Well, when you so focus on one little element and disregard the environment that we're in, the environment that we're in is a global bear market essentially. And the fact that the S&P 500 is up 3% in a year where most everything is down 15 to 20% or more, that's a really good year of outperformance for U.S. stocks. You could be a German investor right now. You could be a Chinese investor right now or an Italian investor in their stock markets, and things are not looking nearly as good as they would be for you despite this recent bout of volatility in both large cap and small cap stocks. You can see most of these look very similar now. There's the U.S. stock. They're all below falling moving averages. The U.S. stock shows a bullish posture. Brazil is the strongest that we've got right now. Russia is relatively strong at 73 on its intermediate line, though it is falling. Everything else looks very similar to the U.S., but worse because they're all below 20. All of these are all below 20, showing strong bearish postures, well below their moving averages. The S&P is trying to get going again on its intermediate line. A lot of these showing clusters, and as I showed you last week, not last week, but yesterday, I showed you the clusters that were forming on these. Now again, the week, the little bit of an upward move we had today kept the clusters from eventually forming on India, China, but you can see they're still there on the UK and on Germany and on Italy. You can see South Korea didn't get this cluster with the rally. It had off of its lows today. Russia's relatively bullish. Brazil is relatively bullish. China's not down as much. Japan and China are not down as much, or France. So these are some of the bigger losers. But again, not too often you get weekly clusters on these, even if they didn't end up showing today. They have been there from all the way up to yesterday for the week. So that just kind of shows how oversold most of these international areas are. And again, the S&P 500's managed to, despite all this weakness that we've had globally, and including the volatility, here's the volatility we had over the last couple of weeks. Compare that to the volatility we've had in most of these areas from those January highs. See how much we are down. That's the volatility we've had in these areas. It's been more than just a couple of weeks. So these are going to find a bid. These are going to find some value opportunities. And when these rally like they did from last time they got clusters, early 2016, they rallied. You can see what the U.S. stock market did during that rally in a lot of these international areas. All right, when you take a look at the calendar for next week, you can see the early next week will be really quiet. There's not really anything going on. A lot of Fed speak, the Chicago Fed, the summary of all the national, all the regional manufacturing indexes, the ISM also. That will be released on Monday. Usually not market moving, but you can see we got new home sales and we have durable goods orders coming out, and then the big one is Friday. The GDP number, the advanced figure for the third quarter, is due on Friday. So we got a few things Wednesday and Thursday, but the big The big economic release will be on Friday, so people will be watching for that. There's a lot of earnings due out. You can see from an earnings calendar standpoint some of the big names: Halliburton, Kimberly-Clark, Hasbro. I mean, these are all due up Monday morning. When you look at Tuesday and what you got going on here Tuesday, we'll sort it by the bigger companies: McDonald's, 3M, United Technologies, Verizon, Lockheed, Caterpillar, Biogen. You can see a lot of these other names: Texas Instruments, Corning down here at the bottom. That's all on Tuesday. On Wednesday, you start getting a lot of tech names scheduled for release here. Let's sort it by the market cap again and get to the bigger names. There's Microsoft, Visa, AT&T, Boeing, UPS, General Dynamics, Northrop Grumman, Boston Scientific, Norfolk Southern. So you see all the names. Ford, let's do out Alexion. Those are all popular names you can look at on Thursday. Again, sorting by the bigger names here. Those are on the other end of the spectrum. Amazon, Alphabet, Intel, Merck. These are all after the market closes. So Merck, UNP, Altria Group. I mean, a lot of energy names, a lot of staples. Raytheon, Celgene, some healthcare, some defense names on other days as well. And then finally on Friday before the market opens, nothing comes out usually after it closes. We'll finish the week with, staples and energy names: Phillips 66, Colgate Palmolive. It's kind of the two bigger names. REIT here, Weyerhaeuser's turned into a REIT, and Cabot. So there's some of the bigger names on Friday. So it's a big week of earnings, especially in that FANG area. People will be watching very, very closely to see what kind of earnings they have and how to go, how that's going to impact, especially those growth-oriented stocks that we expect to lead any bounce. If we get one, we expect to lead that bounce, are those higher tech names. And we'll see if they lead it up higher or if they push us down to that 2,700 level on the S&P 500, because those earnings are not strong or positive enough for what the market is currently priced in. Remember, the market's been pricing in all quarter, but the reality is in the last couple of weeks, that pricing has been askew because of the big sell-off. Any stocks that might come in below their earnings estimates, that might already be priced in, considering how much we've already fallen to get to this point. From a sector rotation standpoint, in the last couple of weeks, not surprising again to see your safe haven areas, utilities, staples, and real estate are actually up. So the market's down 4.5%. These areas are up 2%, 2.25%, 3.25%, 0.25% for real estate. There's your communication services down about 3%, along with healthcare kind of outperforming the markets there. Even though the stock market didn't form lower lows, some of these other areas did. You can see materials formed a lower low. Industrials got really darn close to a lower low. Energy formed a lower low. Technology slightly higher. Discretionary here formed a lower low than what we had, and then the financials up a little bit. So you can see, and there is some weakness in some of these areas from this week. You can see if I were just to go over the last 5 days. There's the last 5 days and what's happened this week. The market's up a little bit. Some of these stocks are up a little bit. And you can see, this actually includes last Friday. So here, let's go to 4 days. There we go. So this would be Monday, Tuesday, Wednesday, Thursday, and Friday. It's actually 5 days, but there's your good week that we've had, especially here late today. Staples and real estate and utilities really doing well. They held up okay yesterday, and they had big moves higher today. And then you can see on the other end of the spectrum, again, like as I mentioned, energy and materials, and there's discretionary, all forming lower lows this week, and all coming in with where the market itself was really flat. They came in with some relatively decent losses compared to especially the strong gains that you had in these safe haven areas. If I were to go back and just look like year to date, on those safe haven areas. So there's staples, this pink area here. Materials is really struggling still year to date. But you look at utilities in purple, it has been weak, and it's really been doing much stronger. You look at real estate, also this one right here has been weak, and it has been relatively weak here along with staples, and it's bouncing. So these safe haven areas were such underperformers. On the other end of the spectrum, technology and discretionary, and communication services, which we don't have a whole lot of history on. But those two, which consist of a lot of stocks that are in these two areas, and healthcare. I mean, look at the strong returns that they had year to date going into this sell-off. So the sell-off has brought us down about to almost 3% return on the S&P. But you can see these areas, technology and healthcare and discretionary, they're still about 10% still year to date, even after the big selling. That just kind of shows who's been leading and what's been leading, and these other areas have been lagging so much, and now there's a rotation coming out of these areas. You expect those to bounce up, but eventually you expect these areas, especially energy and materials, if the dollar is weak, to take their spot, their roles here at the top of the chart as we rotate around. So a lot of stocks have had extreme moves. We've been kind of talking about that for most of this week and different ways to trade that. And here's one way to trade a stock, and there's a reason I have all these lines here. I'll explain what they are here in just a second. Mylan is a stock that's also had an extreme move. Its Bollinger Bandwidth is at an extreme as well for the past year. It's at the dotted line, which is the highest level for it over the past 150 days there, sessions or trading sessions. So it's and you can see when it gets really high at these levels, it tends to, the Bollinger Bands contract, which means we go sideways. In fact, this time of year, here's the earnings for last year. This time of year, we were coming down from an extreme level about this time of year, and we really contracted coming out of that earnings into the beginning of December. Okay, we're going to do something similar here. Well, if we can, if it does, then we can try to make money in this area. We can do that by saying, okay, how about we sell a call and sell a put on either side of where the stock is right now. And that's what these first blue lines here. This first blue line is where the stock has to trade as this line contracts, and we go, potentially sideways, or at least slow down this move, like similar to what we did last year. Last year was a big up move. This year is a big down move heading into this. But coming into earnings with higher volatility, taking advantage of that by selling those options. And then now I've got that range. That's the range. Now you'll see these other two lines, they're the break-even levels that we have. So if we stay in there by expiration, which is December the 1st, right here, where my vertical line is, then I'll make something. So this is kind of a max gain or nothing type of a trade, right? We either get a maximum gain, there's a little bit of wiggle room for a less than maximum gain, or we'll have a loss. Now these other lines, they are the difference between, you can see I've done an iron condor trade as well. So the iron condor trade, to get the equivalent return, similar to what the short strangle, you have to do two of them, which means we'll have to use $296. Now, the short strangle requires, in this margin account, on this particular margin account, requires $326. So very similar returns for the amount of, and very similar margin requirements required for both of these trades that you see. So what I've shown with this line, you can see where the maximum losses are, where I get that $296. Well, this line would be where the short strangle, where the stock would have to trade for me to get if that $296 loss on the short strangle, which is equivalent to my maximum loss on that iron condor, to kind of show you the difference and show you how the iron condor, you see, to get that loss, it's at $27 on the downside and $38 on the upside. So $27 is right here. There's where you get the max loss in the iron condor. So I've got some more room to the downside to work with the strangle. $38 is right here. Again, I have, this line is at 40, so I got a couple of dollars of room to work with to the upside too. So the strangle actually gives me more. It's 2 fewer contracts in the condor. It gives me more room to work when I compare apples to apples, equivalent credits, similar margin requirements. This short strangle gives me more wiggle room, especially with how high volatility is. It gives me more wiggle room to trade with. And as I mentioned before, the margin requirements are similar. Even the short strikes are similar, 36 and 29. So the stocks, I still make a similar return in the similar window, but if it doesn't work out and it goes outside that window, the strangle gives me more room to work with to the outside. So again, expecting this Bollinger Band with the contract, which we've seen before at this time of year, coming even out of earnings, and if it does, and we've seen it before over here too, coming out of that earnings where it just really goes sideways. Over here we had some volatility out of earnings. Eventually ended up in the same spot, and then coming out of this earnings we went sideways for a while. So if we follow a similar pattern where we go sideways out of earnings, we have a way to take advantage of that and take advantage of the extreme move to get to this point and profit from the expected contraction in the bandwidth going forward out of that earnings. And with the earnings too comes the expected volatility crunch, which we'll profit from as well by selling these 2 options with this short strangle. All right, now I want to hear from you. Use that link popping out in the top right corner of your video there, and let's talk about tonight's market outlook. Let's talk about tonight's trade idea. Any questions you have for me about what I talked about or what I didn't talk about. Let's keep the discussion going over the weekend in our Market Scholars forum and specifically our Market Outlook forums. Remember, you can participate in those for free simply by subscribing to our site. As always, thank you very much for watching tonight. Have a great rest of your weekend, everybody. Remember to subscribe to our YouTube channel, click the thumbs up icon, and comment. Also, remember to follow me on Twitter, join our Market Outlook community on Facebook, as well as our Market Scholars community at marketscholars.com. Thanks again, and we'll see you all on Monday.